I mean, we would take it with both hands. As it is, we are seeing a falling trajectory of the WPI, I think all the way from April, or rather May. May was 15.88. From then, we have seen a decline, and 11.2 was what we were expecting. This 10.7 is so much better than the 12.4 last month. So, you know, in 2 months, in 1 month, that is from August to September, it's almost a 200 basis point, almost a 200 basis point fall. Okay, more like maybe 170 basis point fall in the WPI. So that's very good. And the fact that it is driven by food makes it even better. The food index has come down month on month by 0.5%. And a lot of that is because of WPI, edible oils. Edible oils, I mean, anyway, since Ukraine had shot up, but on the wholesale level, it has been declining. And that's a 7.32% decline month on month on the WPI in edible oils. It had declined in August as well. And that was a 0.7 decline. This is an even bigger decline. The manufactured products inflation also has come down. That's important because manufacturing has a larger weight in the WPI. In the CPI, it's ulta. You know, CPI has a bigger weight. Manufacturing products inflation has also come down to 6.34 versus 7.51. And you guys know better than anyone how much metals and chemicals and all have been declining. And that's, see, this is WPI. In CPI, it takes time to reflect. A lot of manufacturers don't pass it on because they're making up for a time when they didn't, when they couldn't pass it on, or they're simply fattening their margins. So WPI is very reflective at the wholesale level. Over there, you are seeing manufacturing products, which means it could go to the bottom line. A fall in WPI is directly positive for the stock markets because some of them may not pass it on. Manufactured products, month on month, the index is down by 0.5%, and that's very positive. Okay, other things, vegetable index, that's the one that's up at the WPI level. That is negative for food and for consumption. And of course, a little bit for FMCG companies, but not much. The fact that edible oils at the WPI level is down 6.7 month on month is very important. As you know, Mangalam, so many FMCG companies need that as an input. So directly positive.
That Adani Wilmar had said in its second quarter update as well, that palm oil prices and soy oil prices are down 40 to 50% from the peak. While, you know, directly it impacts their business on a negative basis because they have to pass on those price cuts to consumers and their margins compress. But this is a big positive for all the FMCG companies because, you know, it will fatten their margins or at least increase the volume if they pass the prices.
I would take it all the way down when it comes to edible oils, even to the Maricos, ITCs, you know, the whole range. Many of them pass on the hikes in driblets and pass on the cuts also in driblets. So when the cut comes, immediately it is beneficial for them. And eventually, I guess, to boost demand, they could be passing on some of the... I've rarely seen a price cut in parachute, have you?
No, so
or a price cut in a sun drop or a sun, any of the...
They don't cut the prices. Oils. What they do is instead they increase the grammage and tell you, okay, 20% extra coming in from us, and that lures the consumers to go ahead.
I have not seen increaseflation, if you please.
Let's hope they do it.
Sounds like a contradiction.
Lata, before we get to our guest, I had a quick question. Is this a precursor to a possible softening CPI? Because that's what, you know, big brokerages are estimating as well, that maybe 7.4% was the peak for CPI for us.
That is absolutely the expectation. But that may not be entirely only because of the WPI, because the inputs are fewer. Not everything is an input. See, cereals, what took up the CPI? Cereals and vegetables didn't have much of an input from the WPI over there. If there are unseasonal rains, which there were in October, it can still impact higher CPI. So there isn't a one-to-one correlation, is all that I'm saying. Here, like, for instance, manufactured products inflation has come down. That doesn't have a direct one-to-one correlation with the CPI. But it is a peak also because the base becomes very high from October. So that itself will pull down inflation. We will again have an ugly month for CPI in January, but, you know, you can look through that. That discussion for another time. Let's ask the expert, Rupa Regenitsure, the chief economist from L&T Finance, joins us. Rupa, almost a 200 basis point fall from August to September in the WPI. Parse it for us, for the economy, for CPI, etc. What's the impact?
See, first of all, this print is primarily because of sequential easing in global commodity prices and also favorable statistical base. Some of the state government has taken on edible oils, like drastic reduction in import duties has also helped. And now internationally also we have seen edible oil prices falling. And that step has helped, some of the domestic oil manufacturing companies also, like mustard oil, etc. The prices have come down. So this is good for cooling off inflation.
Okay.
But
the question that Ekta just posed, if you didn't hear, should we therefore expect some benign impact on CPI?
No, because the point is that even WPI, the trend may get reversed in October because OPEC plus recent decision, to reduce global oil supplies. Again, oil prices have started rising. So it's not that it will have a monotonic tendency to come down.
Okay.
Secondly, CPI is also very, very sensitive to, base effect and what will happen to food inflation, fuel inflation, etc.
Fair enough.
As I said in my earlier interview to you, food inflation, I'm really not worried because we are going to get bumper food grain both from Kharif and Rabi if I go by the ground level reality.
Okay.
All these standing crop losses of vegetables and all is a transient phenomenon. But point is that fuel prices, again, there is a worry because of geopolitical stresses, etc. So we have to keep our fingers crossed. But I think domestically, definitely CPI prints will ease in the third and fourth quarter, especially in the fourth quarter.
Okay.
Yeah.
Would it be fair to say that because of this fall in WPI that you're seeing, I mean, it's across the board, manufactured products, WPI has come down month on month by 0.5%, and the year-on-year number now stands at 6% compared to over 7% last month up until August. Across the board, the manufactured products seem to be seeing lower cost of raw material. So should we expect that to mean better corporate margins?
See, Lata, from the supply side, it's a good phenomenon because global commodity prices have eased. So and WPI is, it shows the impact of imported raw material costs, etc. So that is getting directly reflected. Okay. Having said that, what matters for margins is demand also. And global commodity prices are falling because recessionary tendencies there are growing. So I'm only keeping my fingers crossed that here, if the domestic demand uptick, which we have seen in the festival season, if it continues, then yes, it will be a good, trigger for margin expansion. But if demand uptick doesn't hold, then, we will also face some kind of
Fair point, fair point. Rupa, thank you very much indeed for joining us. So these are very key takeaways. The fact that it is lower is good news. I mean, it is 170 basis points lower than August. Yeah. And if the bar chart can come up again all the way from May, it is a 510 basis point fall in WPI. But as Rupa says, not everything goes to the margin. One, because we may get a higher WPI, more than 10.7 next month, simply because there's a rupee depreciation. And so much of this is imported inflation that you may actually see a tick up in some of the WPI components. Secondly, you may not be able to pass on the cuts much, or you may have to force to pass on because globally there is the recession. So whatever you are exporting, you have to price it lower if the destination economies cannot buy. And why? Even in the domestic economy, if the buyers are not able to afford and you're seeing the impact on volumes, you will have to drop your prices. So the impact on margins, we shouldn't run away with any enthusiasm. At the moment, all we can say is this is good news. It could become a little higher next month because of rupee depreciation.
I think the fall in inflation is something that the street is taking with both hands. So the Nifty has now moved to a 330-point gain. Just look at the intraday chart. It's almost a 2% rally that you're seeing. In any case, we had a very strong day, but now this additional positive data has been received very well by the street. The Sensex
Rekha, you were saying
1177 points high on the Sensex. I mean, Yeah,
No,
go ahead.
In the morning, you'll be discussing one of those Lakshman Rekhas in the Nifty, Nifty puts, or rather the DMAs. So if you cross 17,340, is there a chance that there will be more?
So that
Basically crossed,
more covering.
Yeah, so we've crossed the 20-day DMA of 17,274. So there was some short covering, and now we're looking at the 50-day moving average, which is 17,500. So now that we've crossed the 20-day moving average, the question is whether we go there or not. But importantly, we are seeing some short covering. The 17,000, 17,100, and 17,200 calls, which were written yesterday because no one was expecting this big gap up to come by. But what we'll do is actually take a short break, and on the other side, we'll discuss all of this and more. But more importantly, we'll also talk about the IT companies. They are the ones that are providing the big boost to the Nifty as we speak. Infosys single-handedly. Let's take a short break, come back, discuss that.